everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at WisdomTree Asset Management. We're looking at a passive income solution without the volatility this week. And with the U.S. interest rate landscape returning to a more historically normal setting over the last year or so, investors are now presented with a backdrop that hasn't been witnessed in literally more than a decade, if not longer. So, as a result, I believe the bond portfolio decision-making process could benefit from taking an active-passive approach from a solution standpoint. And if you remember from my podcast last week, I highlighted an active core strategy for fixed income investors to consider. But for this week, I wanted to feature a more passive income solution that comes without the volatility investors have been witnessing in the broader bond market over the last couple of years. And in my opinion, Treasury Floating Rate Notes, let's call them FRNs, offer bond investors an approach that can be combined or barbelled, right, with other fixed income solutions when building your portfolio. Treasury FRNs, just for the record, are backed by the full faith and credit of the U.S. government and are reset with the weekly Treasury 3-month T-bill auction with an accompanying spread. Now, the WisdomTree Floating Rate Treasury Fund, the ticker's USFR, allows investors to invest in this asset class in the user-friendly ETF structure. So why should investors consider Treasury FRN's USFR? Well, first let's go to the yield curve. People talk about the Treasury 2-year, 10-year yield curve, but the 3-month 10-year yield curve is still inverted. And so that means investors can attain an income advantage without taking on the duration risk. Remember, Treasury FRNs are reset with the 3-month T-bill weekly auction. What's the second point? Fed rate cut expectations have been dialed back considerably. So this yield curve advantage should remain in place for the 2025 outlook as well. And then finally, even if the Fed cuts rates more than currently expected, the Treasury 3-month 10-year spread would have to steepen considerably from present levels, which, by the way, is minus 15, before it will return to any type of neutral territory. So let's look at another aspect of this. Let's look at it as USFR compared to the AG. So first point, even with the Fed cutting rates, USFR has outperformed the benchmark AG year to date. Number two, USFR offers investors a solution that considerably mitigates the volatility that I mentioned before that we've seen associated with the broader bond market in the post-COVID era. And then finally, a return back to a normal Fed interest rate cycle positions USFR as a key component to managing duration risk in a bond portfolio. So the bottom line, as I mentioned in the opening, interest rates have now returned to a more normal historical setting. And even with rate cuts, investors could still be presented with what is viewed as a higher for longer regime compared to what many market participants had been accustomed to during the 2010-2021 period. So I'm going to end it there. I hope everybody has a great rest of the week. Be well, and happy Thanksgiving. And before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.